Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include home values, real or forged, my interview with Halcyon's Kirk Donaldson on the question, why is it so expensive to originate a mortgage, and construction spending is now down for 7 months. Do you know that Figure is shaking up the lending world with their 5-day HELOC? Offering borrower approvals in as little as 5 minutes and funding in 5 days. Figure has hundreds of partners in the banking, credit union, home improvement, and, of course, IMB space, embedding their technology. Lenders give your borrowers an experience they will rave about, and you can learn more at figure.com. Pro tip, here's a friendly 4th of July reminder that absolutely no one is going to watch the videos of fireworks you record on your phone, unless you post them on social media and make everybody else watch them. Here's another pro tip, don't. You can bet anyone flying someplace is watching the flight delays due to staffing and weather. You can bet that people are watching home price appreciation, especially in terms of home equity, HELOCs, and cash out refinancing. Did you know Figure is sponsoring the podcast this week? Expect home price appreciation to slow, which isn't necessarily a bad thing, due to increased supply, steady rates, and weaker economic conditions. The Fannie Mae Home Price Expectations Survey forecasts average home price growth of 2.9% in 2025 and 2.8% in 2026. Zillow projects a 0.7% decline in U.S. home prices between May of 2025 and 2026 due to increased housing inventory. The Mortgage Bankers Association expects home prices to rise by 1.3% in 2025, followed by a 0.3% increase in 2026-2027. But who cares the value of a home, especially when you can forge it? Now, investors, especially non-QM investors, have ceased buying investment properties in Baltimore and surrounding areas. Lenders have seen investors suspend investment properties. Owner-occupied and second homes are still allowed. And a list of appraisers and appraisal companies that are on their suspended list are rumored to be making the rounds. Yes, rumor has it there was some kind of bankruptcy default event associated with an LLC or group of LLCs associated with the same group of investors. This group of investors was involved with hundreds of investment properties in Baltimore and in the surrounding area. These were DSCR loans, business purpose loans, non-agency investment properties. Evidently, the LLC group of investors went under and Apollo started digging into it. Turns out there was some kind of appraisal fraud on where property values were overstated. The rumor is that they were ordering the appraisals through an AMC, but they were flagging these properties by offering to pay $444 for the appraisal. Apparently, the appraisers would see the 444 and know they needed to pad the value. There's apparently an investigation going on right now, and an Apollo-backed entity discovered some appraisal fraud in DSCR properties, resulting in some investors suspending lending in the city, at least 4 investment properties, until they get visibility. DSCR lenders are a fairly small community, and they talk to each other. So a number of them have been circulating a list of appraisers they won't accept, individuals they won't lend to, as well as associated entities. Portfolios are, no doubt, being examined to see if they have exposure, and in the interim, the path of least resistance is to cross off Baltimore and a couple of other areas for a while. For today's interview, I wanted to welcome to the show Halcyon's Kirk Donaldson to talk about the question, why is it so expensive to originate a mortgage? As well as explore how automation, compensation models, regulatory burdens, and tech interoperability could reshape costs and lead to a more efficient future. He's founder and chief executive officer of Halcyon and is a SaaS-based financial technologies professional with more than 2 decades of experience in corporate structure, client acquisition, development, financial services, and business management. I told you that this first question was going to be a little tongue-in-cheek, but it is something that needs to be asked, and that is, why is it so dang expensive to originate a mortgage?
Yeah, and I think that there are multiple components to that, all the way from just the very, very beginning, pre-beginning, which is, lead gathering, generation, vetting, and the cost to acquire leads, good quality leads. Then it starts with verification, right? And once you have that lead, right, millions of people that have absolutely no interest in buying a home walk into open houses on the weekend because they quite frankly have nothing else to do, or they just want to see what the inside of that house looks like. All the way from, leads that are purchased out there in the market, which I understand that market's changing a bit, but what's old is new. It's sort of like the tax prep business, right? There's a set guideline, but not there's ways around those rules. And so you see that expense start right in the beginning, pre-beginning, right? Before an LO or anyone else knows that they even have a good qualified person they're spending hundreds of dollars on, dead ends. And I think that some of the changes and some of the brilliance that's going on out there is the consolidation in the market that you're seeing in purchasing either the online shops or teaming up with companies like Total Expert or whoever has those relationships with the realtors. And so it starts there. I think that the cost to verify that borrower, not just as a qualified person, but a person, right? A good start is knowing that someone's alive, right? And so it's a great way to service, make sure someone services their debt is that they're living, right? And so you get these fundamental basics like doing a background check or verifying who you have on the line is real, it's not fraud. And that piece of the business should be automated, right? You have amazing tools out there that can do things out on the web, that can verify through employment, that can verify when people are posting, what they're posting, what their job site is posting. You can, instead of take the Social Security Administration, for example, they have what they call the death list. That list is updated. If it's updated, it takes them months. And that fraud happens within the first few days, weeks of someone passing away. And so, that business, in our opinion, should be commoditized, and lower the costs. It's the number one issue with FHFA right now, and it costs lenders millions of dollars a year. And so, if you go through the tech stack, right? You go through the diligence that has to be done, and then the end result is when you do have fraud, the cost is so great, the margins are so thin these days because it costs so much to underwrite that when you do have an event, when you have fraud, it's catastrophic to a lender. It wipes out your profit margins. You've already paid most of the people out there for underwriting that loan, and that fraud hits in reverse. It touches a lot of people, and it's very expensive.
There's a ton to unpack there, and my original thought was I was going to ask you what parts of the process are most ripe for automation, and I thought, well, maybe I should ask what parts of the process are most ripe to reduce costs, but they're intertwined in some ways. I mean, when it comes to ways that lenders can really focus on reducing costs, I think a shorter part of the answer would be, what do you feel like the ones that are most ripe are? Sure, but then kind of more importantly for where we are today, what's stopping lenders from enacting some of these things or examining their processes more closely?
Right. And I think you nailed it right on the head, right? In that they are intertwined, right? And so if you have fragmented POS and LOS systems, right? If they aren't talking to each other in an efficient manner, if your APIs aren't built in the right way so that you are utilizing the full capacity of the tools that you're implementing, that creates fraud, gaps for fraud, right? It creates time gaps, it creates cost, right? And it creates inefficiencies in being able to implement those tools, right? Because, I always say that, you sit in the demo of many of the technology companies that are out there, fintech, and it sounds great. It really does. And they have tools that, used properly, can innovate, they can reduce costs, they can do all of those things. But if you're not implementing them in a way that is efficient and robust so that you can use that end-to-end solution, either you're not putting it as far forward as you possibly can in the process, whether that's the POS, right? Whether that's not putting the tools in the hands of an automated system, or even as basic as the LO being able to use those tools and vet, it just doesn't work, right? You have an incomplete solution. It creates frustration, and it forces people to go back to their old ways. It's hard enough to get people to change as it is, right? And because of the cycle that we went through during the boom of technology adoption, and we did, I was a beneficiary of it, Loanbeam. That boom created a lot of suspicious concern on the capabilities of technology companies, right? And so you heard a lot of really, really good stories. I always say just because you can walk and just because you can see the sun doesn't mean you're going to walk on the sun, right? And that's what a lot of the promises were, that this is going to be completely end-to-end automated, that people are just going to look at the sky and mortgage loans are going to fall out of it, right? All of that ended up being BS, and not all of it, but you get one or two and people become very suspect, right? Things become suspect. You start to question, and then you don't implement that, along with just the nature of adopting new technologies of a good enough. I mean, we have examples where, we're integrating into the largest LOSs, but if they're not utilizing all of our tools and putting us in the right spot, people have to dig to either find it, or it's not as efficient as coming directly to us or to anybody. And what ends up happening is you have to leave the environment. If you have to leave the environment, then it's over. And that's why we try to integrate into the POS system, the LOS system. We try to get them to talk. We try to do all of those things as a solution. And I'm using ourselves in kind of a negative light, and that's just the reality, right? That's the reality of what happens out there.
Well, I need to follow up quickly on something you said there, because if the reality is that people are reluctant to change, it has to beg the question, how do we get the industry to change? How many more quarters of unprofitability can we go through? How long will it take for people to actually change? Will it take and I sound like I'm preaching here, but because I'm getting all riled up, but is it going to take UWM and Rocket and these large players to scoop up that much market share before companies say, gosh, we got to do something different? What will it take to get companies to change?
Right. Well, the way that we look at everything that we put out the door, just on a pure business sense. This isn't me. I understand that I'm not curing cancer. I'm not feeding the children, right? I'm in the business of being in business. And so if we're going to do something, it has to be faster, better, and cheaper. All three, not or, right? And I think that, that's where you get LOs, underwriters, right? People in the back office, right? Processors that will adopt the solution because it is all free, right? If it's one of those things, right? Different parts of any company look at solutions completely different. The CFO doesn't care that it's easier for you to click through an app, right? Is it cheaper, right? The LO doesn't care that it's cheaper. It's, can we get loans through the door, right? Underwriters, if it is efficient, but only efficient in that it's a threat to a job, right? So you have to understand that you're dealing with different mentalities and psychology on every different level of job, right? And in different positions, they look at it differently. And so just to say that we have an incredible solution, you should be using it. Well, you're wailing at the wall, right? That is not going to fly. And the only way that people start to adopt is if you see real results, right? And the results are, we are processing more loans in an efficient manner, that we are reducing costs, that it is taking out fraud that's out there. Where are my risks? Are you addressing the risks? Just because, look, how easy would it be if we just published everybody's social security number and all of their finance data on the web in real time all the time, right? It'd be really easy, right? But you're creating a much bigger problem than you're solving. And if you walk in the door and you don't take the time to ask a lender, what's the problem, right? Ask the GSEs, Freddie and Fannie, what are the problems you're trying to solve, and then solve for them and make sure that they're aligned. you're not going to get adoption. You're just not. You're creating a solution because you think it's a good idea. And there are many companies that have come into the industry and failed because, and I'm not picking on Silicon Valley or anybody else. I'm just saying that, people come in and they say, well, this is the way it should be done, but they don't know the inner workings of the mortgage environment, the industry, the complexities that there are in underwriting a loan, and there are many of them, right? Maybe too many, and that also contributes to cost. You're going to have a solution that's not adopted because you don't understand. You don't understand the actual problem.
It's funny you say that. And regular listeners of this podcast will have heard me say before. When I started at SoFi, we thought we were going to come in from the side and disrupt the mortgage industry. We spent billions of dollars on the process. And you realize very quickly you get bogged down in these regulatory hurdles, and there's just legacy systems you have to deal with that you can't really get around. And it's hard. It makes it frustrating, and it makes a lot of these tech companies say, "Do I actually want to go into mortgage?" Sure, there's an incredible opportunity. It's a $2 trillion annual market, but at the same time, it's so easy to get bogged down. And how much of the cost structure, at least currently, is driven by regulatory complexity versus how much of it's driven by inefficiencies in the process. And maybe that would lead to your answer there could help people decide where to better focus their efforts. And part two of that, in addition to regulatory versus inefficiency, would be how can lenders collaborate with fintechs and data providers to streamline borrower data collection? Yeah, like you said, it would be great if everybody's social was published on the internet, but it's not a world that we're ever going to live in. There are these regulatory hurdles. How can tech help with that? How these tech bros or tech companies, if you will, how can they kind of think about it from a different way and help the mortgage industry get out from it's stumbling over its own feet?
Yeah, we talk a lot about kind of what's wrong, and I'll say a little bit about what's right. Is I think that we're working in a direction where we are going away from, you can't see my quote fingers, but the document side of the business, where whether it's a PDF, right, or it's physical paper, it's all the same as far as I'm concerned now, right? And so the way that I think that companies have started to rethink what they're building is that APIs are everything, right? That direct source of data, the source of truth, is where the industry needs to go. It's efficient, it's in real time, it is safer, it eliminates part of the fraud out there, and that part of it. So my history of 23 years in OCR, it's wrong, right? I mean, it's just flat out, and the percentages are getting better on accuracy. But if there is anything that is inaccurate, you don't know where it's coming from. You have, hundreds, if not thousands of people in offshore facilities putting eyes on it. It's inefficient, it's expensive. And through imaging, through AI, through direct integrations, which are the best part of the API direct integrations, getting that data from source of truth, whether that is through the IRS, through pay stubs, through bank accounts, through deposits, being able to access that in a secure manner, which is key, is source of truth, right? And it is as efficient as it gets. You can populate all kinds of forms. You can do calculations. You can make the market much, much better. One of the problems that we see is that, quite frankly, it's on the vendor side. And we talk a lot about commissions that LOs are making, and how much it is to underwrite, and how they haven't modernized that compensation plan. But also, if you are selling two equal solutions and you compensate your salespeople as a percentage, or just based on that revenue, which is the nature of the game, and they have two products that do similar, maybe one's better than the other, right? But very similar, or they're exactly the same, and one is selling for $50 and one is selling for $5. Which one of those products are those salespeople, those vendors going to push? And so everybody has their hand in the cookie jar, and everybody wants to say they want to reduce costs. They want to reduce the cost of underwriting. It starts with the products and services that lenders are forced to take. And when you have certain vendors that are approved or not approved, right, that are accepted, or I'm not even talking about rep and warrant it, but similar scenarios, you have a limited set of options. And I always say there's lies, there's damn lies, and there's bundled pricing, right? And so a lot of fees are hidden there, right? And if you break apart the individual components of that bundled pricing, it's tough to find out what your cost is, because it's impossible to charge $150 and say something zero and something else, getting credit is $50. I mean, it's a tough thing to do.
That's good. Lies, damn lies, and bundled pricing. I'm glad you brought up the compensation side of things, because that is the elephant in the room, and I do need to address that. And for the sake of fairness for this interview, I won't limit it to LO comp, although that's a massive portion of the cost to originate. But there are processing costs, underwriter costs, all these other things where strides have been made in automation and technology that might make those prime for maybe some disruption. And I'm going to ask you, what extent do these compensation models across the mortgage supply chain, and yes, especially for loan officers, inflate origination costs? And how much is a smaller part of it, but how should they evolve is probably a bigger part of it.
Right. I think that they naturally evolve with efficiencies, right? It takes a while for lenders are implementing these new technologies. They're starting to see lead gen in a different way. If you own the site of origination, right, whether through realtors or the sites, and they're coming in, and you are able to utilize the tools that should be used way up front, right? By vetting these leads, by vetting the potential borrower. And that vetting, even including, so like we do pre-authorization, we can find out someone's income, do the income calculation, and now you're finding out that this person is a good person, this person can qualify as far as income, that the piece of real estate in question is real, right, with an approximate valuation, right? You're being spoon-fed that lead, right? And I say that from a position of, I've had every title you could possibly have. I've only had one job. I'm in sales, right? And so I am an advocate of salespeople. I think they wag the dog, right, so to speak, and they're very, very important. But how valuable are you if you are being handed not qualified borrowers, right? And so that percentage of payout is going to come down. It has to, right? It has to, because you're not out there, pounding the pavement, finding leads, developing those leads, vetting that person, vetting the product, the property, that part of it is all what you have to reduce cost. And eventually lenders are going to say, okay, look, it's not a call center, but it's pretty darn close. Like, what are we paying out 30, 40% on originating a loan that we, not only pre-qualified, we qualified. And I think that's the round turn of all the technology, is that, we're going to get to a place, maybe not tomorrow, but we're going to get to a place where when a lead comes in the door, within seconds, it's a qualified loan. Like, you could sell it. Like, we've done the income calculation. We got the data directly from the IRS. We did the income calculation and verification. We verified who this person was and their background. We have their direct deposit. We know that they have money in the bank. We know that property address. We have, a title record there. And so for the most part, it's a closed loan. I mean, what the GSEs are doing right now, which you could take both sides of that, in that, they're cannibalizing the business of vendors like, I mean, quite frankly, we're not a benefit of it, where you're populating a calculator for free, but boy, is it efficient. Like, if you're feeding that data in there and you're getting, maybe it's not immediate rep and warrant, but they'll get there. You've got a loan that you can sell. And if you know you have a sold loan when it comes in the door, what am I paying anybody for?
Good salespeople are worth their weight in gold, but also some of these files, if they're not doing as much work as they used to, maybe they don't deserve to be paid in the same way. And we might see a split there when it comes to, hey, if it's a vanilla, conventional conforming sort of thing, you're going to get paid differently than if you went out and that was your referral network and you were the one that had to work the file because the borrower had weird income, those sorts of things. But for my last question here, because we've gone a long time and it's certainly been interesting, but how does change actually begin? And I would say, for the compensation piece we just talked about, nobody wants to be the first company to cut comp because there goes your good staff and employees to the competitor that's still willing to pay more. What does it actually take for change to be enacted now that people, I mean, it's like people know things are out there in theory, but well, what's it going to take to put things into practice?
Right. I think it's kind of a chicken and egg in a bit. I know that's as cliche as it comes, but what you have is lenders having the power to stand up to some of the vendors, right? And you take, and I'm an expert in only a very, very small sliver, right? And so if you're have a product like transcripts where in the old fashioned way of 4506 and vendors and everyone that's involved is getting compensated when they fail, right? You're rewarding bad behavior and they fail a lot, right? One of the dirty secrets in our business is that post close, they fail 6 out of every 10 times. If they fail, in pre, it is 30% of the time, which means that every time it fails, I'm paying you more and more money for something that doesn't work. And if the lenders stand up to vendors and say, okay, enough, right? We're just not going to do that anymore, right? There are other solutions out there. And it goes back to building the tech stack in the same way, right? Which is, not beneficial to us, right, personally, but if you build it the right way and you can change out vendors, right? And the way that you're integrated is that you can become nimble, which means spending a little bit of money, right? And setting up, maybe a side-by-side tech stack while you're building the other, you can work the market in that you're not over a barrel. You're not so integrated with one provider, right? And dependent on them that they can charge you whatever they want, right? And lowering those costs, making that efficiency in the infrastructure, not just changing out because these people have AI in the name of their company, they must be good, right? But actually able to change vendors and be able to use the market against itself as far as the efficiencies and pricing. You'll reduce the pricing. You'll make loans more secure. You'll be able to do those anti-fraud steps for dollars instead of, hundreds of dollars. That'll lower the cost. It'll make efficiencies. It'll make efficiencies in the back office as well as with the LOs, right? And once those costs start coming down and they become more efficient and the leads become qualified, saleable loans all the way up front, right? That gives you the power to then come back to everyone, all of your employees, and say, okay, guys, like here's where our costs are, right? What would you do if you were in my shoes? Here are our top costs. And that being said, I've got the greatest salesperson I've ever met. And so, she's worth her weight in diamonds. And sometimes, it's worth that, right? And sometimes you have to look at your entire company and say, here are the efficiencies. We have a responsibility to the market to reduce costs, right? Because the one thing we haven't mentioned is that at some point you have to look and say that as an industry, we have a responsibility to the borrower, right? I understand we're all trying to edge out a profit or as much as we possibly can. But you have a responsibility to the borrower, and we should be lowering costs for the borrower here, right? Not just for ourselves. And sometimes that gets lost because some of the vendors out there, some of the large companies, their volume has gotten cut in half, and so their answer is to double prices so they can maintain their revenue. Well, who is that fair for? It's not. It sure as hell isn't fair for the borrower, right? It's not fair for the lenders, right? or the people that work there, because that causes layoffs, right? And so it is a cycle. It's a cycle that all of these things are interrelated, and that's why it is so complex. But I think at the fundamental base of everything that we've discussed, it is starting with the way that you construct the infrastructure of your technology so that you can implement the best solutions, that you aren't locked in. Lots of vendors are out there, they brag about, well, once you're in, right? Then they can't get you out. Well, that shouldn't be the way it is. And I understand that that's not great for my personal business, but it shouldn't be the way it is. You should be faster, better, and cheaper, and that's why they're using you, not because you're now integrated and they're stuck with you, right?
Great way to sum it up. Kirk, I really appreciate the time today. Thank you.
Of course. Thank you. Thank you for having me.
Does anybody else love a good spat? After President Trump intensified his pressure on the Federal Reserve to cut interest rates, giving Fed Chair Powell a handwritten note demanding ultra-low rates and accusing the FOMC of inaction despite minimal tariff-related inflation thus far, Powell yesterday acknowledged that the Fed might have already lowered rates were it not for the scale of current tariffs, a sentiment echoed amid mixed economic data. We learned yesterday that job openings surged in May to 7.77 million, suggesting labor market resilience, while ISM manufacturing showed elevated input prices that complicate the Fed's path to easing. Meanwhile, political tensions are rising. The Senate narrowly passed the one big, beautiful bill, with Vice President Vance casting the deciding vote, and Trump signaled he may let the current tariff pause expire after July 9th, further clouding the inflation and trade outlook. Construction data in May marked the 7th consecutive monthly decline in spending, driven primarily by a slowdown in new single-family housing due to high costs and borrowing rates. Both residential and non-residential construction saw declines, while broader sentiment remained subdued due to geopolitical and trade-related uncertainty. Despite a slight rebound in manufacturing activity, supply chain tensions and the inflationary effects of tariff uncertainty continue to pressure firms' inventory decisions. Today's economic calendar is on the lighter side, ahead of a packed one tomorrow, and kicked off with U.S.-based employers announcing 48,000 job cuts in June, down 49% from May's 93,800, according to Challenger Gray and Christmas. However, the second quarter saw over 247,000 job cuts, the highest second quarter total since 1.238 million cuts were announced in 2020. We've also received mortgage applications from MBA, which increased 2.7% from 1 week earlier. Last week's results included an adjustment for the Juneteenth holiday. Later today brings a Treasury buyback in 20 to 30-year coupons for up to $2 billion. We begin the day with agency MBS prices slightly worse than Monday's close, the 2-year yielding 3.79, and the 10-year yielding 4.28 after closing yesterday at 4.25%. Let's wrap up with a joke and some housekeeping. Here's a tale about last year's 4th of July company picnic softball tournament. At our annual company picnic, the underwriting department always played a game of softball against the branch managers. Last year, the underwriters won 9-4. But on the company bulletin board the next morning was the following notice. Quote, "The branch managers are proud to announce that upon the conclusion of this year's softball tournament, we finished in second place overall, having only lost one game the entire season. We'd also like to take this opportunity to offer our condolences to the underwriting department's team for finishing next to last, having only won one game during the entire year." Thanks again to Figure, which is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days. Figure has hundreds of partners in the banking, credit union, home improvement, and of course IMB space embedding their technology, giving borrowers an experience they'll rave about. Learn more at figure.com.